Samir Arora from Helios Capital then on the show. Samir, hi, good morning. Great to have you on the show as always. Samir, almost at 16,300, had a touch and go moment with that mark already in the week gone by. Is the market surprising you, amusing you, or are you completely unfluttered by the price action?
It is amusing me and also pleasing me because at the end of the day, we are very much connected with what happens to the market. Although we all keep saying that we are bottom up investors, but when there's such a strong tailwind of the overall market, that helps everybody's portfolios. So now, does it surprise me? I mean, you can say plus minus a few percent or on a few stocks, but generally speaking, if we don't look at this market on a rolling basis and say, oh, what happened in the last 1 year, because in that year, everybody's NAV is up 80, 90%. But if you look at it on a calendar year basis, then to me, that looks like a normal this thing that in 2020 calendar year, the market was up some 20%. In 19, it was up some 10%. In 18, it was flattish. And in 2021 year to date, it is up some 20% or 18%. So it doesn't look wild in any way.
So, Samir, have you changed your portfolio strategy? Any ins, any outs in the last month?
Month, I don't know, because I have been quarantined for 14 days. Today is my day 11. No, today is my day 12. But even in quarantine, I can enjoy the market and everything. But generally speaking, over time, we have done one change. That change is that in our long short fund, we used to run with some 100% long and 30% short. And over the last year, we have realized that there is a big disparity in performance, even if everything is going up between some sectors and some other sectors. So we have expanded our gross, which means instead of being 100 long and finding 30% shorts, we are now some 120% long and 50% short, trying to play the difference between good sectors and not bad sectors, but underperforming sectors, even though in theory everything is going up. So that is a big change because we can see a big, the market itself is going up is good, but there is intra-sector, there's massive difference in performance, and we are trying to capture that nearly for the first time in our life because previously we were just buying and saying that on the shorts we should not lose. Now we are saying if we make more on the longs relative to the shorts for that extra percent, that is massive value add.
So, Samir, much like the global rich list where rich get richer and poor get poorer, you think that's how India Inc. and the market performances as well is going to be? The strong only get stronger and the weak weaker?
The strong companies, you mean? Or you mean the strong people in terms of obviously
Stocks.
when there are asset increases, obviously people who have starting assets will, if they go up 30% and they are starting with 100 and the other guy is starting with 5, then it is true in terms of that. But when you are talking, I believe you're talking about bigger companies, better companies, and I would bet anything, absolutely anything that will not happen. Actually, we are short many of them, and that is where we are playing the difference because it is clear from only 500 years of data that you cannot have the same companies doing well for 30 years and 40 years, and you can't start after some stocks have done well for 20 years to say that these should do well for another 20 years or even 10 years or even 5 years. And that I am going to make a full presentation on it someday. But in general, I think the whole idea of this market being considered good is that the market has broadened and expanded. And at any point of time, a large number of companies are doing well, and it is not the same old companies.
Okay, hi Samir, this is Mubina as well joining in. I was just reading
Yes,
some
sir.
of your tweets, and one of them reads that, okay, a couple of years ago, you had stocks which had P's of 15, 20, and 30, and they have done very well. And now the expectation that these same stocks, which have now reached P's of 70s and 80s and 90s, should continue to do well, could be a little stretched. Are you pointing to the entire consumption basket here? And do you think
Not
that
all of
that
them.
rally that we have seen in the likes of an HUL, etc., will pause? Sure,
Actually,
go
it's
ahead.
not. That's the whole point. There is no rally. It is a relative rally because the whole market is going up. I just made a this thing analysis for my presentation. So if I just tell you that people who bought, and we have nothing against levers, we are not short or long, but it's a great company. But if you look at levers and hear stories of people how compounding has made money, then you will find people who say that they bought it in early 80s or whenever the IPO happened, late 70s, and they make every year more money in dividends than they invested at that time. And this is the power of compounding, which I totally agree. But if you look at it for the last 21 years, or maybe even longer, I saw it from 99. From 99 to now, levers has underperformed the market, including the dividends that you have got. So the people who feel good have a different story. But for the last 21 years, this story of buying compounders has not worked in this case. Similarly, I tweeted today because on the same analysis that everybody says that Mr. Buffett has made money by long-term compounding, and I think it is wrong. It doesn't mean that Mr. Buffett is wrong. It is a wrong interpretation of his performance, because if you look at the stocks that he's held for long, like Coca-Cola and American Express and Wells Fargo, all of them have underperformed the market for the last 20 years. So if anybody had bought it during the last 20 years, or not anybody, because in between there might have been some points from where again it has outperformed. But if you had bought it 20 years ago, for the last 20 years, they have underperformed the market. So that would mean that they are not compounders if timing of buying matters. So if I say that from 2000 to today is underperformed, but somebody will come up and say, but see, from 2017 it has not underperformed, let's say, that would mean that the timing was more important than just buying any of these compounders. I don't think there is a single case where straight compounding, any price, any time has worked, and it is not going to work, is my not only my belief, it is my bet, and it is my absolute 100% this thing conviction.
Okay. So basically, just buying stocks and keeping them in one of those coffee can portfolios, as we call it, for generations and generations is not something, Samir, that you're basically in favor of. You mentioned about how leadership keeps changing. So
No,
right
that's very
now, where do you see leadership? If the last
so
decade was dominated by go ahead.
sorry. You continue, please. Sorry, there was a lag here. Yeah.
No, so bas- no, so basically just that where do you see then the next sectoral rotation? And of course, I'm sure you have a clarification to what I said, so I'd like to hear that
No,
too.
I was saying that simply that the same stock does well could be because of the initial timing of somebody. And that also, in the end, there are maybe 30, 50 stocks that do well in life. And in hindsight, when you look at them, it looks that if I had bought this stock on that day, I would have done well. The question is to identify these stocks at the beginning of the cycle and not to justify their performance for the last 20 years. That's what I'm saying. We have lived through this, and our fund's performance is actually better than any of these even 300 baggers. But the point is, when you are living live through them, that means to identify in the year 2000 whether you should buy an HDFC bank or not because it is very high valuation versus some other bank. That is the issue. Today, to come and say that actually this was the best stock to buy and therefore it proves compounding, that is not the case, because at any point of time, some 30, 40, 50 companies would have been massive compounders. The question is whether you can identify them in advance. And the idea of saying that even Mr. Buffett couldn't identify them in advance is just an example of that. That is how I'm trying to say. But in the end, in hindsight, there will always be 20, 30 stocks that would have done very well. And somebody can say, see, this is why compounding works. The question is, could you have bought with the model that you have these stocks 20 years ago? So, for example, let's say we say that we look at last 15 years history to identify a good stock. That means 15 years ago, if you had bought these stocks that have done well today, and you are saying that we look at 15 years history to buy them, and therefore we are going to buy them today. 15 years ago, did they have a good 15-year history for you to have bought these stocks at that time? Because we are looking at the performance in hindsight and then trying to justify going forward. So our theory is very simple, that there are three or four big picture secular themes, which in India's case are financials, private sector financials, even still consumer and consumption, and tech, which now we have expanded to tech, pharma, and specialty chemicals over the last 4 5 years. But the point is, let us not go for the extremes. That's all. Don't. It's not that we know whether 30p is good or 28 is good or 38 is good, but we know that 80 and 90 are not good. And even if they are good, once in a while, that stock will also do well. But if you look at it rationally, if you look at it statistically, and you look at it historically, a very, very high starting valuation would be, in hindsight, maybe justified even once in a while, but not while you're going in with managing other people's money and trying to manage it rationally.
Samir, let's talk about what's happening in the India Internet newly listed universe. Didn't get a chance to speak with you about Zomato, a shareholder yet?
No. So my theory on the internet stories is in India is, it's like if you visualize a sugarcane machine. So you pass the sugarcane through that and you get good juice, and that is the juice being taken by the insiders. Then if you be like, I've seen this in South Extension when I used to go there, then they would pass the same sugar cane from which the juice has already come out. They will squeeze and then they will twist the cane a little bit and try and pass it a second time. And that is what the IPO guys get. And then they will put a few together. They will take 5 6 of these canes from where the juice is mostly out. And that is the return for the day one investor who buys post listing. And so we will say that we'll buy some other juice.
That's the most intriguing and hilarious analogy ever.
So
Juice
the
wala
point
in
is,
South Extension
okay, now let
Market.
me talk
Okay, but
let me
that's
talk in fund managers language. Let me talk in fund managers language. The point is,
sure.
the IPO price may be attractive, but you're not getting it at IPO price. I'm talking about the general, and once in a while, if you get
Yeah.
anchors different, then you are buying it 30 40% higher, because mostly if it is not going 20 30 40% higher, then that means the IPO itself was a flop in today's way of looking at an IPO. So the IPO itself, which has recently, the size and the valuations have been increased live in front of you, while you are discussing, the same newspapers are reporting that 3 months ago it was valued at this much by private investors, and you are being given that at twice and thrice that valuation. And then you are supposed to pay another 20 30 40% premium to that on listing to start your journey. The thing is, we compare everything to, oh, people who bought Amazon and people who bought Google, see, they did not care about prices. The reality is, there is only one Amazon and one Google. You can't compare every IPO to saying that this is Amazon. So it's okay. We can move and wait for some time.
But that one Amazon, one Facebook could also be perhaps, a Paytm, Samir. It could be a Nykaa. It could be a car trade. It could be a policy bazaar. The thing is that Zomato has only marked the first of the internet
No, that
companies.
way,
There's a
yeah.
slew of them lined up in the pipeline.
So we see how it goes. But the point is, by the way, I was not against Zomato. I think Zomato was actually good, because Zomato came at a price where it would have been in the top 80 90 companies of India. And at 80 100 companies, there can be companies of different kinds. And we'll see as it goes. So it was not against Zomato. Actually, we were willing to buy it on day one if it had listed below 100 or so. It's just that it went beyond that, so we let it go right now.
Okay. Let me just quickly take stock of what the market as well is up to. It's tempered down about 0.3% higher, while we're slowly and gradually moving to 16,300, which was the high point of a trade last week. Sabir, the key focal point for the large cap listed universe continues to be banks. What's happening is a very interesting rotation within banks, where there seems to be, at least that is what the stock price data seems to be indicating that there is a leadership change what's happening in banks, wherein HDFC Bank and Kotak Bank are taking a back seat, and you've got ICICI Bank and SBI clearly leading the way forward. What do you think is happening here, considering you've been tracking banks for a while?
No, not only tracking, we own all of them. So yes, you're absolutely right that over the last 3 years, ICICI. So we had HDFC Bank as our top holding forever, but in the last 2 years, because ICICI Bank has done so well, it has become our number one position. And we also bought State Bank of India because it was a massive, very cheap when it fell in June, July last year, and then it has very good subsidiaries. So the question here was, I guess, in terms of HDFC Bank, that. They were having these technology problems, and have they become the defenders right now instead of themselves being on the attack for all their life? And we believe, and I can tell you that we bought some HDFC Bank on Friday because we believe that HDFC Bank, the problem that it had in terms of Reserve Bank of India, is just a sheer obvious big picture thing that people are not sitting on their ass and waiting for these things to happen, and they will also come out and show their things over time in terms of what they can do or what they have done, and plus minus X number of months, God knows how many months that is, they will get approval from RBI, because it would be very unreasonable to believe that the Reserve Bank of India is penalizing India's number one bank in terms of underwriting quality and all, and saying that there is no way you can come back into the good books. And all this is a matter of effort, focus, time, money, and I'm sure all of that has been spent by HDFC Bank to cover whatever shortfall they may have perceived at that time. That is the Reserve Bank. And over time, this is a story of that maybe relatively some other stocks do well initially, but this would be a bank as long as it does much better than the market, even if it underperforms a little for some time because of size and because of being maybe owned by everybody. That is part of life. It would still be only a few 100% better than on these consumer staple companies which are trading at 80 and 90 multiple and growing their revenue line by 10% for the last 10, 15 years. So that is what I was meaning. That for some of these, not every stock has become overvalued. Not every stock is overpriced. Because if you look at the financials and you look at their last 10 years performance or even 20 years performance, they grow mostly in line with the stock price moves in line with the earnings. So if you look at HDFC Bank, maybe for the last 10 years at least, I saw recently, its earnings growth is around 20% and the stock price appreciation per annum is 20%. So in no way comparing it relative to history, relative to itself, relative to the market, that it looks that suddenly it has become overpriced because of the current hype in the market. So our problem is with companies that were growing at 10, 15%, but their stock price appreciation has been 30%, and which we enjoyed for 80, 90% of this time. And then we say it is better to step off and not bet only on these super high valuations continuing for companies whose growth rate is in line with nominal GDP. But that is not the case for the financials, so we like nearly all of them. They can also be viewed as a play on opening up and stronger economic recovery and everything else for which you don't have to find opening economy plays. The financials do that job quite adequately.
Interesting. So, Samir, how's quarantine been? Have you been catching up with the Olympics action, India's performance, and especially historical one on Saturday? Any good books that you've read that you would like to recommend to our viewers?
First thing is, I have realized, even though I came into this quarantine with many books and Netflix and Amazon Prime and HBO and all that on my iPad, that the best thing has been to sleep. Because whenever I try to read a book, I mostly go to sleep. But I just finished Veer Sanghvi's book, A Route Life, which is good and it was light reading and easy to do. But mostly I have slept. I've not been able to read much, even though I
Sensible
thought
choice.
I will read a lot. Even though I thought I'll read a lot. But yeah, I think it maybe reading is to be done when I'm back in my home on Thursday.
No, that's absolutely fine. Sometimes sleep is what the body needs and rest is priority. Good chatting with you, Samir, as
Thank you
always.
very
Good to
much.
have you on the show.
Thank you. Thanks a lot.
Thanks.